Today, let's break down UnitedHealth Group ticker symbol UNH using 8 core pillars of value investing. These pillars help us understand whether a company is not only growing, but also financially strong, efficient, and fairly valued. UNH currently trades at around 16.5 times earnings. This is important because BIC is the PE ratio, tells us how much we are paying for each dollar of profit. A lower PE, especially below the company's historical average, can indicate that the stock is reasonably priced or even undervalued. In this case, UNH's PE is below both its 5-year average and the overall market, which is a positive signal for value investors. ROIC measures how efficiently a company turns invested money into profits. Over the last 5 years, UNH has generated an average ROIC close to 9.5%, which is solid. The most recent figure is slightly lower, around 9%, making this metric borderline. This suggests the business is still efficient, but recent cost pressures may be impacting profitability. UnitedHealth has grown its revenue at roughly 10 to 11% per year over the last 5 years. Revenue growth matters because it shows that demand for the company's services continues to expand. Strong and consistent top-line growth supports long-term earnings power, which is a very positive sign. While revenue has grown strongly, net income growth has been more modest, around 2 to 3% per year. This tells us that although the company is getting bigger, margins are under some pressure. Still, profits are growing, which confirms that the business remains fundamentally profitable. UNH has approximately 906 million shares outstanding with no significant dilution. This is important because when a company avoids excessive share issuance, existing shareholders keep their ownership stake. Stable or declining share counts support earnings per share growth over time. UnitedHealth's long-term debt relative to its free cash flow is around 4.5 times. This means the company could theoretically pay off its debt in just a few years using its cash generation. For a company of this size, this level of leverage is considered reasonable and financially healthy. Free cash flow has grown at nearly 7% annually over the past 5 years. Cash flow is critical because it represents real money the company can use for dividends, buybacks, and reinvestment. Strong cash flow growth adds confidence to the quality of earnings. UNH trades at about 17 times free cash flow, which is below its historical average. This metric is especially important for value investors because it focuses on cash, not accounting profits. A lower price to cash flow ratio suggests the stock is attractively valued relative to the cash it produces. When we combine all 8 pillars, UnitedHealth Group passes most value investing criteria. It shows strong revenue growth, solid cash generation, reasonable debt levels, and a valuation below historical averages. The main risk to monitor is profitability efficiency, reflected in the slightly lower ROIC and modest earnings growth. Overall, UNH appears to be a high-quality business trading at a reasonable price, which aligns well with long-term value investing principles.